Good morning, everyone. Welcome to this update for global stocks and commodities for the 6th of November. It was a pretty rough week with markets down quite sharply, but we're almost to the end of this circus in America that's the election, and you can't help thinking that the corruption of Clinton and all of the mistakes and incompetences that she's made, the vulgarity of Trump, it's all part of the same theme that we saw with Brexit, that we saw with Malcolm Turnbull almost being tossed out and Pauline Hanson getting 10% of the vote in Australia. It's all part of the same theme, and that's that. People globally are just fed up with the position of the elites, the disparity between the haves and the have-nots in terms of wealth and power, and I think it's going to continue, and it's probably going to intensify on a big picture level. So whoever wins in the middle of this week coming in America, it's not really going to change the big picture that's really going on in society, and of course that will directly impact what's happening in the stock market. So let's have a look at what happened last week, but just first a few general comments in terms of the big picture backdrop. The American GDP data that came out, the headline number was quite impressive, and the some parts of the market actually reacted reasonably positively to it. And overall, there were certainly some things to like. But when you looked underneath a little bit, one of the troubling things for me, particularly given that the consumer is 70% of the American economy, is that consumer spending was cut in half from around 4.3 down to 2.1, and that's a massive cut, and that's not a particularly good trend to see. Whether it's just a one-off piece of data is another question, but that's certainly one to note. Now, I read some very interesting statistics over the last couple of days that the stock market is actually pointing to a Trump victory with about a 75% probability. That's what history shows over a lengthy period of time, and basically the rationale behind that is that when the stock market goes down in the period of months before an election, then that tends to make people feel worse in terms of their own situation, and as a consequence, they're more likely to throw out the incumbent party and let someone else have a go. On the other hand, when the stock market has gone up in the period immediately leading into the election, then people tend to feel good about the economy, they tend to feel good about their personal circumstances, and so they're more likely to stay with the incumbent. So from a psychological point of view, those statistics don't surprise me. And that's really what we've obviously had the stock market weaker leading into the election, and that's what history is telling us at the moment, but it remains to be seen. But however, far more important than the outcome of the US election and whatever the short-term GDP data is, are US corporate earnings. We're still progressing through that earnings season, and also global growth. Now, global growth it's certainly not it's not buoyant. It's not nearly as good as central banks would like it to be, but it's not all that bad. It is. We're still getting some very slow growth. There's a lot of concern about what's happening with the Chinese economy and the data that was out in the last week. Again, unless it's a complete make-up in terms of the outcomes in China, then they're doing okay. They're getting through okay. And I did note that Alibaba, which is one of the largest stocks in China, is still growing at a terrific rate, and that's a real barometer of the consumer in China. And Alibaba was able to report growth in earnings of 55% year on year, and that's a huge growth for such a big company. Q3 earnings in the US are now looking like they're going to be showing positive earnings growth of around 3.6%. from the previous quarter, and that changes the sequence of 5 quarters in a row where earnings fell. So that's the first time in a while that we've seen positive earnings growth in America. So that's certainly a good positive. And the other thing is that overall, the S&P earnings yield, as opposed to the dividend yield, so earnings yield is the basically the total profit that the companies are making as a whole, expressed as a percentage of their share price. And the earnings yield is at 6.1%. Now, yes, the US rates have been sneaking up a little bit as they have been around the world, but the US 10-year is still only at around 1.75 to 1.8%. And so when you compare that to the corporate earnings yield of 6.1%, you can see that stocks still have a great deal of attraction in the US. So there's not really a fundamental basis for a massive readjustment in where people are putting their money, unless of course you think that corporate earnings are about to fall off a cliff, and other data just doesn't really support that. So from a big picture fundamental point of view, I find it hard to get really panicky about what's happening. However, there is certainly a lot of nervousness out there, and markets are capable of doing anything when we have that situation. Now, the S&P had a rough week, down 41 points in total. And as I indicated earlier, the earnings, corporate earnings and global growth data supported a rally, but from what I've seen, there just seems to be a lack of people that are prepared to stand in the market and buy. Fund managers are pulling back. They've increased their cash levels on the sideline, and no one really wants to do anything ahead of this election result during the week. So a combination of that, plus of course the falling oil price, which was a very bad week for the oil price, down around 15% over the last 2 weeks, and clearly support has been broken in the S&P. That wasn't the situation when I did the last video last weekend, but that is now clearly broken. But the Russell 2000, which had broken support last week, looks horrible. It really does. So the small caps are sending a very, very clear message. But as I said, it's inconsistent with some of the other data that I mentioned on the previous slide. And when I look at the Russell 2000, I want to have a look at the big picture structure of that index over the last 3 or 4 years. And we've definitely got a broadening top that does look pretty ominous. So we can't ignore that. However, I do make the point that could take another year or two to play out. And that would be consistent with the way that I thought that this would all unfold. And that is that 2017 would perhaps broadly be a positive year, but one with increasing levels of volatility. So we're going to see, I think, greater fluctuations than what we've seen in the last year or two. But on balance, I had to really stay with the stock market, perhaps setting a new all-time high and maybe making it somewhere up around the 2,300 points. But make no mistake, you really want to buckle up, because this is going to be a pretty bumpy ride, that's for sure. Let's take a look at some charts. We'll start with the S&P, and you can see where we sat last week with the index sitting right on this really important support level, or what was previously support. So these were all the highs. We got a breakout in mid-July, and then since then the market has struggled. And now in the last week, we have clearly broken that support now, and you can see 5 days down in succession. The market is now oversold, and we do tend to get short-term bounces from oversold, even in a fairly significant decline. The targets, it's possible if Trump wins and the market takes it badly, that we could be looking at a test of these lows from June, which is around about 2,000 points. The market in the US finished at 2,085, so it's another. That's about another 4.25% to the downside is the potential. Now you also notice that I've drawn in here a declining trend line along these tops. It's also equally possible that we could get a bounce back to retest that trend line, not necessarily immediately, but that would also be a likely outcome. So basically the risk that we've got is really from this point here down to this point here. So if you're an investor trying to figure out what you should be doing at the moment, then the first thing is, don't panic because it's from oversold. We're likely to get a bounce. And I think that bounce will be a good opportunity for you to perhaps make some longer term adjustments to the way that your portfolio is positioned. But in the very short term, that's your risk, if particularly if Trump happened to win next week. So not a healthy looking situation with the S&P. Now the Nasdaq has also started to break down, and that really reflects the fact that the FANG stocks, Facebook, Amazon, Google, Netflix, those stocks which had been holding the Nasdaq up very, very well, they've started breaking down. You can see they had a pretty rough week, and that has dragged the Nasdaq down as well. So those stocks that have really held the market together at an index level are certainly showing signs of weakening off. But the real area of concern is the Russell. This is the small cap index, and this is what it looks like on a big picture level. So this is the last 3 years, and you can see that there is definitely a broadening top there, and quite often that will be the precursor to a much more significant decline. Now, I'm not saying that that's going to happen, and equally, this could go down a bit further. It could rally up. I mean, no one knows in the short term, and this could end up back above these highs here. So I don't think there's anything to sort of panic about, other than just to note that this is the big picture. It's not a pattern that you should ignore, and with all the other things that are going on around the place, it's one that you need to take note of. But you'll notice that the Russell 2000 is quite oversold at the moment. We're down now below 30 on the RSI, and you can see it's been a very sharp downturn. If we zero in a little further, you can see we've got support down here about 1100, which is another 60 odd points to the downside. So that's entirely possible in the short term. And you'll notice that we've got a crossover of these, quite a clear crossover of these shorter term moving averages, which which can't be ignored. So there's certainly some potential danger out there, that's for sure. Looking at the US dollar index, because that's at the heart of a lot of these trends, you can see that we've got an uptrending channel in place. We got to the top of that channel, and so the dollar is rolled over and headed back down again. It'll be very instructive to see what it does around the bottom part of this channel. On a bigger picture level, that's what we're looking at with the dollar. So it's just really been a really big washing machine of sideways action between 92 and 100 since early 2015, so nearly 2 years now. But that uptrending channel is still in place. The US 10-year looks very similar. So that's the 10-year yield. Got up to about 1.88, has pulled back to 1.78 in the last week. But certainly you'd have to say that interest rates are on the rise. And finally, I want to look at, as you know, I follow the bond market extremely closely, and this is, I don't have it queued up yet, this is basically the junk bond index, the high yield index, and you can see that we've pulled back. This was the big dip that we got in February when markets really panicked about the oil sector and a lot of a cascade of perhaps defaults, corporate credit defaults. That didn't play out, at least in that time span, and the market recovered quite sharply from around 75, got up to about 87, 88. But you can see is now definitely started to roll over. We've now formed a lower low. So there's definitely been a change there, and you can see the elevated volumes that have occurred in that ETF as well. So clearly there's a change of character in that high yield corporate junk bond market. Just while I'm here, let's look at the Australian indices. There's the ASX 200, which looks virtually the same as the banking index. So a pretty rough week, as you can see, and we've now just taken out those lows from September, and it's not looking particularly pretty in Australia. But again, as we've got with most global indices, we're down in a position of oversold now. There's the materials sector, so that's your BHPs and your Rios, etc. And you can see that that's held up much better. So very, very clearly, as I've been mentioning over the last few weeks, there is a rotation going on globally from the previous yield stocks, and it's finding its way into areas such as resources. So there's really no question about that rotation that's going on. The Australian dollar finished steady, just under 77, but you can expect that to bounce around a lot more with the US dollar. Our index was down 94 for the week, and this derating of the high PE stocks, these are the high quality, the high growth stocks, but the ones that have been trading for a number of years on high PEs of 25 to 40 and even above. That derating continues. It's not requiring any bad news. Stocks aren't being sold down because they've released anything negative or because anything's changed in their business. This is just the market no longer being prepared to pay the high multiples that they previously were. And I'm sure part of it is certainly overseas selling as well, because certainly from what I can ascertain, American fund managers are looking at the global scene, and they are starting to pull back and perhaps focus more on stocks, American stocks that they perhaps understand a little bit better in their own market. Now, this sector rotation that we're seeing from yield stocks into growth stocks and into resource stocks inevitably causes some terrific opportunities. So amongst all of the concern about the downside and what's happening, don't lose sight of the fact that this sort of volatility does throw up opportunities. So, that's my very strong advice to you. Don't feel that this is a market that you should sit out of, because you're going to be missing out on some fabulous opportunities. And it just keeps reminding me of the famous words of people like Warren Buffett, that when others are fearful, you need to be bold and step up, and that's the environment that we're in at the moment. So I'd really strongly encourage you not to be put off by what you're seeing at the moment. But equally, focus on quality stocks and buying them on oversold extremes. If you do those two things, I think you're going to probably do pretty well. But you need to be very clear on your game plan, and you need to be a little bit resilient to the short term. Turning now to precious metals, gold rose by another $20 on the week, so a solid week for gold. Short term, if Clinton wins, I think you've probably got to expect that a bit of the premium will come out of the gold price. But I think gold would go sharply higher if Trump wins. And as I indicated earlier, statistically, with the stock market falling sharply into the election, that 3 out of 4 times the incumbent gets thrown out, whether they're Republican or Democrat. So you can't write off a Trump victory at this stage, that's for sure. But look, stepping back a little bit, longer term, every scenario that I look at, inflationary, deflationary, whether central banks do A, B, or C, whichever way I look at it, it's strongly positive for gold over the longer term. But you've got to recognize that gold is a volatile sector, and gold stocks amplify that volatility. And so, I can't give anyone any kind of guarantee that the gold stocks couldn't necessarily dive around considerably in the shorter term. Gold stocks are looking mildly better, as we'll see in a minute from the GDX chart. And as I indicated last week, if you're significantly underweight in gold stocks, it's okay to start rebuilding. I may not necessarily do it in the next couple of days if you haven't done it already. Let's just hold off and see what the election brings. And it's possible that we could see a few more months of sideways in gold stocks because of the uncertainty. Now, I've had a number of questions from members about what they should do, and this really comes back to the perennial question of, you know, investors and traders want the upside that precious metal stocks can provide because it is and it will be hundreds and hundreds of percent. We've already seen that this year. The GDX index went up about 180%. So this isn't something that's theoretical. This happens every cycle, and we're in a bull market for gold. There's no question about that in my mind. So there is huge upside in gold stocks. But in the short term, they could equally drop another 10%. And if you're sensitive to that, then you just need to recognize it. If you can't accommodate the downside, then you need to significantly reduce your gold exposure and keep it down there. There is no way that you can invest or trade with success if you are constantly worried about what the market might do in the short term. It can't be done. You're going to end up making a whole bunch of really bad decisions. So you must structure your portfolio, yes, to leave it open to the upside, but don't go so heavy that you can't accommodate the short-term downside because you're going to fail. I can almost guarantee it. You must adopt more modest expectations and structure your portfolio accordingly. There is just no other way to put it. So that's the best advice that I can give members that are and also non-members that are anxious about what the short term might deliver, but still want exposure to the upside. You've just got to perhaps have a lower exposure to gold if that's the way that you see things. Let's just have a look at the gold charts. So we'll start first of all with we'll look at silver initially. So you can see silver had quite a positive week there, quite a nice move up on Tuesday. There was a little bit of an upward bias going on there anyway, and managed to hang on to those gains throughout the week. This is gold on a daily chart. You could see quite positive. It went up basically every day except looks like Monday. So the first day of the week we had a little bit of a decline, but from then it was all positive. And if we look at that on a weekly basis, you can see there's still nothing dramatically negative at all unfolding in the gold market. Now, if Clinton wins, could it come back to this 1200 mark? Yes, it could. But remember, the bigger picture is up. We've got higher highs and higher lows. We're in a bull market for gold. So don't lose sight of that. And the fact that gold might drop $100 from 1300 to 1200 doesn't change that at all. And that's what you've got to be able to accommodate. This is GDX. You can see the red 200-day moving average line, clearly an uptrend. We've come down. We've broken through the first support. We've reached the second support level, which is the 50% retracement of the whole move. So GDX moved from $12.60 to about $32. So a massive move, and that sort of move will happen again. But what happens in the very short term? Could this index bounce around for a few more months? Yes, it could. But you can't confuse that with the bigger picture. But in general, gold stocks looking reasonably positive, but just beware of the potential short-term downside. Turning to other commodities, copper surged to 225. That was largely currency impact with the US dollar coming off. But the big mover of the week was crude oil, down sharply to $44. And that's down 15% in 2 weeks. And I've been speaking about the overhang in the speculative futures market in gold that eventually played out with a cascade of selling. I've also been mentioning over the last couple of weeks that we had the same situation in the oil futures market, and that would have to start playing out, and that would appear to have have certainly occurred to a degree in the last week. I think you'd have to say that the odds favour a bit more downside in energy stocks at this point in time. So just be careful in that sector. There's the spot copper chart. So it's regained basically the highs we saw in July. So overall, to wrap it up, and this is at a big picture level, not necessarily a shorter term point of view, is investors that are structured to the level that they are comfortable with, and I'll address that in just a moment, then there really is no need for any action at this stage. If you're comfortable with the volatility and you're comfortable with the way that your portfolio is structured for the long term, then you don't need to do anything. The impact of the election could be significant. If Trump wins, I think you've got to expect the market to sell off sharply, but that doesn't change the bigger picture for investors. So that impact either way will pass relatively quickly. That's not the important question. And I think there are more positives than negatives, as I've pointed out during this video, with respect to global growth, with respect to corporate earnings, and just the relativity of the earnings yield in the US market relative to interest rates. We're still in this situation where the stock market is still the best place to be. It's just we are getting a bit of a washout of some excessive valuations. However, if you're a trader, it's a bit different because you're trading really over a shorter term. You've got different motivations and a different game plan. I think you have to expect some short-term disruption. If you don't, you're just being a bit naive about what might happen. Should you cash up? Look, I can't answer that question as a generality. It's up to yourself. It's a matter of looking at the potential downside and asking yourself if you're comfortable with that. If you do decide that you need to cash up, then don't panic because markets are oversold now. There's every possibility we could see a rebound in the short term. So markets are due for a bounce. So just bear that one in mind. So to wrap it up, the actions that you should take if you do decide that that your current portfolio is, maybe too exposed to precious metals, or it's too exposed to high yielding stocks, or you don't have enough cash, whatever reason it might be, if you do need to take some actions, then you need to perhaps think about hedging your portfolio. If we get a bit of a bounce in the market, maybe put some sort of hedging in place. I would certainly consider taking some partial profit on any big winners that you might have, which are also high PE stocks in Australia. I think that would be definitely a prudent step to take. Get rid of the stocks that have been lagging the market and perhaps have been losers. In this sort of market environment, they're highly unlikely to get any better. So if you're going to cash up anything, then do some cashing up there. Get rid of them. Don't try and make the money back in those stocks. Protect your cash and position yourself to get your money back in the stocks that are more likely to go up. I would certainly raise cash levels, and I would tighten up any notional stop loss levels that you may have. So you can certainly do some housekeeping in the next couple of days. I'd really examine where it is you're sitting, make sure you're comfortable with some disruption in either direction. So a bit of a long video again, but geez, markets are really poised on a knife edge at the moment, and it's obviously going to be a pretty tumultuous week, I would expect. There's my contact details for non-members if you would like to get in touch with me, and we'll see what happens during this week. Cheers.